Let's bring in Bruce Kasman, chief economist at JPMorgan. Bruce, things seem to be, at least based on these most recent data we've gotten, they seem to be moving perhaps in the right direction, at least where inflation is concerned. How do you see it?
Well, I think that's right. It looks like inflation is moving lower, and I think that is going to continue in the coming months. There's a big question about whether it moves low enough to make the Fed comfortable. And I think at the same time, growth is not boomy, but it does not feel like anything is happening that's going to create an imminent threat to this expansion. So I think the economy's on solid footing. Inflation is elevated. The Fed is going to still keep moving here. We clearly have risks as we go ahead, but they're more about an expansion that is continuing to move forward, and the risks that over time that something might happen that's more worrisome.
Yeah, in light of that, I look at something like housing, because we got a lot of that data this week, too. You're starting to see maybe a stabilization in housing. I mean, can the Fed really restrain demand in something like that if you have a fundamental supply shortage? And how much is that a microcosm for this dynamic that the Fed is now grappling with in general?
Yeah, I think you're 100% right. There's a dynamic here where the Fed has hit housing reasonably hard, but it's bouncing back quickly once we've had a period of mortgage rate stabilization, partly because there's still underlying demand and there's tight supply. And I think that's a story which is broadly in place in the economy. The issue here, I think, is that the Fed is going to have to do more. The question is whether they're going to end up doing so much that it's going to break the back of this expansion. But the bottom line right now, and I think it's the one which really is changing the terms of the debate, is many people came into the first half of this year thinking the economy was at imminent risk and was going to break. It's not breaking. And as you're noting with housing and other things, there's actually some potential here for the economy to actually lift in ways that people are not expecting.
Does that mean that looking to the labor data that we're expecting next week, you could see another upside surprise?
Well, we're thinking that the benefits we've been getting from very strong service sector demand and a normalization in some sectors of the economy is going to fade a little bit. But I think this is still going to be a pretty solid labor market. We're going to look for something 200,000 or a little more on job growth. And I think the unemployment rate is going to come down a tick after having made a significant move last month upward.
How are you factoring in, and I realize this is very much a moving target, even just in the past hour, how much are you factoring in this dynamic around student loan repayment, especially if you do have the president saying that there's going to be a temporary 12-month on-ramp for those repayments?
I think it's a pretty small factor overall. I think if you start to break up the consumer into pieces, there might be some areas where you be a little bit more concerned. But the bottom line is this. It looks like labor income in the U.S. is growing at about a 5% pace. It looks like inflation is coming down towards somewhere in the low to mid threes. In that environment, households have real purchasing power. That's really the driver here. And I think if anything is going to disturb this economy in a significant way, it's going to have to be that businesses stop hiring. Until that happens, the consumer is going to be not boomy again, but it's going to be okay. It's going to be plus or minus. And I think the student debt story is a plus or minus story around a still relatively solid consumer backdrop.